right, guys? And then next time we're doing cash flow statement, the next chapter after this one. You guys realize how few chapters there are left? What are we on now? Are you ready here? What is this, 11? Yeah, we're going to do 11 now. And you've read it, of course, right? Oh, yeah, good. That's great. I like that. And then 12 is cash flow, is it? And 13 is investments or something. Is that right? They took the investments and put it into appendix. That's what it is. There's really not 13 chapters, it's sort of 14, right? I think 13 is an interesting analysis, isn't it? But before we do that, we'll do investments. One company investing in other companies, that's not important, right? You don't really need to know that. That's why we put it in appendix. I have no idea what it is. There used to be a chapter. I guess the book was too long, so they took it out and made it in an appendix so people could feel good about not covering it or something. Do you think that you'd like to know about, General Motors owns probably 200 other companies? Did you know anything about how they might handle that? Yeah, it might be useful. Do people make investments in stocks and bonds? Do companies make investments in stocks and bonds? Yeah, would it be useful to know about that? Sure. Sort of like on the bonds. You guys looked at the straight line. You read the straight line. You read it. I told you just to do effective interest method. Why would anybody do straight line? Effective interest method isn't very hard, is it? And it represents economic reality better. You know why straight lines in the book? Because a lot of faculty don't want to make you learn effective interest method. Because you people aren't mature enough or smart enough. Bull. It's a little bit of word, but of course you can understand all this stuff. And you can actually get through 14 chapters in class. It's horrible. You know what? This is an overview class. Isn't that bad? You don't feel like it is what you're doing it, do you? You're like, geez, I'm just pounding through everything. We're going to go in massive depth for those of you who become accounting majors or accounting finance majors too. We're going to go in massive depth on each one of these areas. I'm only going to cover, we cover 9 chapters and then one other thing that I deal with handout material. So only 10 in intermediate accounting in 211. But you'll work twice as hard as the class to get that class. I mean, it's just so much depth. So we're just sort of skimming the top here. Okay, to give you some sort of exposure. And those of you who aren't going to do any more accounting, this is your one shot, huh? And in accounting 102, when you take it, it's your one shot to get this stuff. When you take your marketing class, it's your one shot. Finance, get my grip on this? You really want these classes. And I know as you're taking them, you kind of feel like, oh, God, this is so much work. I just want to be over with. Well, yeah, you want to be over with it, you want to know. Okay? So with me and I keep going. My point was, we don't have much very much left to do, do we? And then we'll start getting ready for the final. Okay? So, and there's a lot of, obviously, a lot of work to be done to get ready for the final. So, good. Anyway, why did I record that nonsense? Who cares? Okay, anyway, let's talk a little bit about equity. That's what this chapter is. Okay? You got 2 kinds of equity, contributed capital and retained earnings. You guys already know that, right? Assets equal liabilities plus equity. That's big enough. Okay? And so we've gone through all the assets, we've gone through the liabilities, not everything, but we've looked at some things. And then in equity, we have 2 types, right? What are they? Retained earnings, contributed capital. Okay? And in this chapter, they talk about a couple types of contributed capital. There aren't lots and lots of accounts in retained earnings and contributed capital. There are only a few. Okay? And we're going to go through these in this chapter. Okay? The main ones. In contributed capital, typically you'll have common stock, and you might also have preferred stock, right? Guess what? They're both equity accounts. How do you increase them? Credit. How do you reduce them? Debit. Big deal. And then there's additional paid-in capital on both. So additional paid-in capital for common stock, additional paid-in capital for preferred stock. That's the amount that was paid in excess of par value, if you have a par value in the particular state you're in, or a stated value if you're in a state that has stated values instead. And there's also no par stock that doesn't have a par value. Guess what? Then you put everything into common stock or preferred stock, and you don't have additional paid-in capital. Okay? It's no big deal, right? Very simple. And then in retained, those are the majority of them. In retained earnings, we would have what? Unappropriated and appropriated. Very simple. The one you have so far is appropriated retained earnings, you guys. We haven't appropriated it for anything. Now listen to this one carefully. This is so easy. All an appropriation means is that you are sending a message to your shareholders, whoever you're using your statements, that you're not gonna pay a dividend, and the reason you're not gonna pay a dividend is your retained earnings are appropriated for something else. You're not like a plant expansion, or acquiring another company, or doing something, right? So, you've got a whole lot of retained earnings, maybe your shareholders would like you to pay a dividend, otherwise, and you just send a message, right? You don't set aside any cash necessarily, you don't set aside any assets, you don't incur any liabilities, nothing changes except for retained earnings. And what you do is you debit regular retained earnings, unappropriated, reducing it, right? Debit it, and you credit appropriated retained earnings. And that's it. Don't you hope I give you that on a quiz or a test? Let's appropriate some retained earnings for a plant expansion. $1 million appropriated for plant expansion. So I've got retained earnings. Let's say I have retained earnings with $5 million here, okay? At the end of the year. And I want to, so that's unappropriated now, by the way. We never call it unappropriated unless we do some appropriation, but it's always unappropriated, regular retained earnings. So then I'm going to have appropriated retained earnings. This is too easy to believe. Okay, I want to appropriate $1 million. Guess what the journal entry is? Take one out of here and put it in here. What's my total retained earnings now? Gee, it's still 5, but 4 is unappropriated and 1's appropriated. Now I do the plant expansion, right? In a few years, and I decide to unappropriate it. How would you unappropriate the retained earnings? Debit this, credit this, and of course in the meantime you added some more to rewrite the retained earnings. But now, if you immediately did it, you'd be back up to the 5 and this would be down to 0. Everybody good? Big deal. Okay, so if I give you something like that, don't worry about it. And if you see unappropriated and appropriated retained earnings, you'll know what it is in a balance sheet now, won't you? Just like that.
What are those mean? What is unappropriated retained earnings?
It's just retained earnings is not appropriated for any particular purpose. Appropriated means that I'm setting it aside to use it for something. Key thing is you're not really setting anything aside. You're just sending a message in your financial statement, right? If you make a journal entry, debit unappropriated retained earnings, right? And credit appropriated retained earnings. What did that do to total retained earnings? Nothing, right? But on your balance sheet, you showed a portion of it appropriated, and what does that tell a shareholder? Oh, they're not paying dividends because they're doing plant expansion. Or they're not doing dividends because they're acquiring another company, or whatever your plan is. But you did not set aside any assets. And usually people think, oh, you set aside a whole bunch of cash or something. No, you didn't. You don't have to, right? It's just, what makes the retained earnings anyways? You think about it. You got all your assets plus your liabilities as your equity, right? Where are your retained earnings? They're in assets and liabilities, aren't they? Really, right? It's in the capital of the company. Yeah.
Okay, so say you put that aside, the $1 million to like viability or something. If you were going to declare dividends, would it be out of the $4 million then?
Yeah, the dividends would have to come out of the 4. Absolutely.
Okay.
You bet. Yeah, you got it. And you never appropriate your dividends. You don't bother. You just take them out of regular retained. Okay, good. So that's a pretty simple one to start with, huh? Why not? Let's start with something easy. Okay, and the author talks about it, but real briefly, but that's because there's not much to it, huh? Okay, it's not a very big deal. All right, let's issue some stock though. We've been doing this, haven't we? We did this a long time ago, issuing stock. Only we called it capital stock, and then we called it common stock and that sort of thing. The way you do this though is you say, okay, I've got for common stock sake, and also for preferred stock, I would establish how many shares are authorized. And the way I do that is I file an articles of incorporation with the state. And it's asking the state to let you do business in the state. By the way, if you are not a felon, right, or some other kind of crook, embezzler, and they know about it, or whatever, because you're a felon, does the state ever want you not to do business in their state? Oh, please don't create any jobs and any economic activity in our state. Go away, go somewhere else. Nobody does this, right? So are they going to give you permission to issue shares of stock and start your business? Of course they are, okay? So you just file articles of incorporation with the state. Yeah. That says authorized. I didn't say that yet, did I? That says authorized, A-U-T-H. You can't read that? Oh, I can't either. R-I-Z-E-D, authorized, okay? This is number of shares, authorized shares. And what authorized means is I ask the state for permission to issue stock, and they says yes, okay? So let's say I have authorized shares. Let's start the business with 100,000 shares. Okay, What's the journal entry for authorizing shares? None, you didn't do anything. You just got permission to issue stock, okay? And then we have issued shares. And guess what? Those are the ones that I issue to the original shareholders, huh? And then anytime I sell stock, right, the company issues stock to shareholders, okay? That's what it is. So let's say that we issue, I don't know, let's issue 60,000 of them. Okay, what would the difference between the 100 and the 60 be? 40,000, and guess what we're going to call those? We're just brilliant about this kind of thing. Well, no, they're authorized. They're just not issued. I think I call them unissued. You got it, okay? So unissued shares would be the ones that aren't issued, right? They're authorized but not issued. By the way, if you issue the whole 100,000, you want to issue some more, you go back and file an amended article of corporation, right, of incorporation, and ask the state if you can issue more. Are they going to let you grow? I think they might. Yeah, so sure, they're going to let you do that too. Okay, and then there's one other thing that we're going to do in this chapter. It's called treasury stock. Now this one's kind of strange. It's buying back your own shares. So let's say I bought back 1,000 shares, okay? I'd have treasury shares of 1,000, okay? Now what I'd say is how many are outstanding. So what I'm looking at is shares authorized, issued, and outstanding. Authorized is the ones I have permission to issue. Issued are the ones that I have issued, which means selling to shareholders, right? Okay? And by the way, is this sales when you sell stock to shareholders? No, it's contributed capital, right? Debit cash, or debit land, or debit building, and credit common stock, isn't it? Right? Or preferred stock if it happens to be preferred stock. Okay? And then the difference between your issued and the ones you've bought back, the treasury stock, I'm buying back my own stock in the stock market. Got the idea? Or if I'm a small company, I just buy out one of the shareholders. If I don't like one of the shareholders, I can buy their stock and they are now gone. Of course, you have to give them enough money to get the stock from them. Or if I just want to buy it out in the marketplace, I can. Some companies think that when they buy the stock out in the stock market, that will enhance their share price. Sometimes that happens. And there's not a lot of evidence. What's that?
Like, for example, my dad worked for a company and bought a bunch of stock, or they gave it to him. And this company was basically like,
Compensation.
Odyssey.
Yeah.
Yeah, so like Odyssey bought his company out, built it up, and sold it to another company.
Yeah. Yeah. So you can do it that way, or in this case, what you might be doing is, let's say your stock's sell, you think it's selling to a lower price, you might buy a whole bunch of stock hoping that the market will notice and bump your stock price up. That's one way, right? Or you might buy back your stock to give it as bonuses to your officers and your employees, right? You might do that. Or you might not like a shareholder and you want to get rid of them. You buy back the stock. Or you want your earnings per share to be more. This one's hilarious, right? The earnings per share, everybody looks at earnings per share, which doesn't mean much. It's just your net income divided by your outstanding shares, right? Is your earnings per share. And you want your earnings per share to be higher. Well, if you buy back some of the stock, you have fewer shares to divide into the same earnings. It makes your earnings per share higher. Doesn't make it a more profitable company, but you know, people do all kinds of silly things. So anyway, there's not much evidence that really helps. So how many would you say are outstanding here, you guys? And we care about the outstanding shares because the outstanding shares are the ones that are being traded out there. It represents the wealth of the company. The ones we own aren't out there, right? That's not being traded in the market. So which ones are being traded in the market? The ones that have been issued less the treasury stock. So what would it be in this case? 59,000. You got it. And I'm going to actually give you points for doing this, okay? Know what authorized, issued treasury stock is and outstanding is. And if I ask for unissued, yeah, that's fine, huh? Okay? Everybody got the idea? So we keep track of the number of shares that are there, okay? We're also going to do stock dividends and stock splits and that the author talked about and authors talked about, and we're going to do cash dividends, right? Okay, so, and we're going to issue this stock. So there's a few things to do here, but it's not a really tough chapter, not bad at all. Okay, then in addition to that, okay, and oh, by the way, for preferred stock, it works exactly the same. Everybody got it? Only usually you don't have very many shares of preferred stock, and you do not have to have preferred stock. Preferred stock, the name implies that it's somehow better than common stock. Guess what? Common shareholders vote. Preferred shareholders usually do not. You can have preferred stock with a voting option if you want, where you have both voting preferred stock. But you don't have to, usually not. So, yeah, what's the benefit? You want to invest in the company, you want to get some of the earnings of the company, but the common shareholders won't sell stock to you. But you'd really like to have a piece of the action, because they're really good, they're profitable. So might you be willing to buy stock where you don't get the vote? You still get a good dividend? Yeah. And maybe stock appreciation too. But the common shareholders are the ones who run the business, okay? So preferred sounds like it's a preference. Although you do get some preferences out of preferred. If the company liquidates, you usually get paid first. It's usually an agreement to it, right? And you get a guarantee, not a guaranteed dividend, but you get your dividend first, and then the common shareholders get theirs later, right? Whatever's left, the common shareholders get. So who's taking more risk, preferred or common? Preferred to get the dividend first, common gets it later. Yeah, common is taking more risk. But who's going to get more return then, probably? More expected return. Common, you take more risk, you get more return, right? Not expected, not necessarily. Company loses money, right? You don't. By the way, who gets paid before the preferred shareholders go? Who gets paid first? No, not the board. Who gets paid first? Their shareholders do. No. Who gets paid first? All the employees and all the creditors. All your bonds get paid first. Which do you suppose gives you a better return? Investing in bonds, higher percentage return. Investing in bonds or investing in stock? Expected return. Which is going to give you a higher expected return? Stock. Why? You have the risk of bankruptcy, right? What happens if the company goes bankrupt? The bondholders get their money. If there's anything left, they get the money first. Then preferred shareholders get paid, right? Well, the bondholders get paid and the employees get paid, right? Employees first, actually. Okay. Then the bondholders get paid, right? And then any other creditors get paid, any other payables, right? Then who? Preferred shareholders. And who gets paid last? Anything that's left over if the company goes bankrupt. The common shareholders. Who's left holding the bag? The common shareholders. Well, what happens if the company really takes off and makes a whole lot of money? And, the bondholders get their stated interest rate, right? The people that the vendors, your accounts payable, they get paid what you owe them, right? You don't get any more just because you make money, right? The employees get what they agreed to. They get their money, right? They're not taking as much risk either, though. Preferred shareholders get their preferred dividend, right? And who gets the bulk of the profit? Things go really well. The common shareholders. So who's at risk of the loss? Common shareholders. Who gets the benefit? If it's really good. Common shareholders. It's their business, right? It's their company. They're taking the risk, they get the return. Okay. So, all right. So on each of these types of stock, then, we'll also have something called the par, I mentioned, or stated value. And we also have a market value, of course, what the stock's selling for. And those are usually not the same thing. So let's say we have $10 par common stock.
What is it, par or what value?
Par is stated value and market value. In some states, it's a par value, and you put the par value in your articles of incorporation, about in the chapter, right? You ask the state if I can issue 100,000 shares, and my par value is going to be 10, right? Get the idea? And that's your legal capital, we call it. Okay, that's what it's going to be. And but it sells for whatever it's worth. That makes sense? Really, what the stock should sell for is the assets less the liabilities, which is the total equity, market value of the equity divided by the outstanding shares. That's what the stock sells for, right? So the market value can be going up or down depending on what's happening with the company, huh? Okay. So let's say that its market value, though, when we issue it, is $100 per share. Oh, so $10 par per share, but market value is $100 per share. Got the idea? And let's say we issue it for cash. That'd be fine. Let's issue some for cash. And let's say we issue, we've got 40 unissued shares here. Let's issue 2,000 shares. Let's do the journal entry for issuing 2,000 shares. This is really simple. And preferred and common will work exactly the same way. So that's no problem either. What would be the journal entry? They're doing it for cash. How much cash are they going to get? The market value of the stock is $100 a share, and there are 2,000 shares. How much cash are they going to get? 200,000. It's cash. What do you want to do to it? Debit it. Yeah. Told you there's not much new here. Okay. So yeah, 200,000. Not bad, is it? Glad you know what you're doing, guys. Okay. What do you want to credit? It's equity, right? Contributed capital. What account do you want to go to? with the par or stated value, you go to the account called common stock if it's common stock, or preferred stock if it's preferred stock. So common stock, I said this was common, didn't I? Common stock would be how much? There's 1,000 shares, it's $10 par, what is it? Oops, it's 2,000 shares, $10 par, how much is it? 20,000. Oh, I wonder what the other 180 is. Maybe it's paid in capital in excess of par. Got it? How much was it issued for in excess of par? That's all. So additional paid in capital or paid in capital in excess of par. What term is this? I'll use. I can never remember. Who read this chapter? One person said she did. She doesn't remember. More than one read it, right, guys? I hope so. Additional paid in capital, common stock. You like it? Or paid in capital, excess of par, common stock. Yeah. Yes, excellent question. New account, what do you ask yourself? What is it? Yes, it's equity. So I've got 2 equity accounts. The total contributed capital is $200,000. I just put it in 2 accounts. Okay? Everybody got it? What if it was land and equipment that they contributed instead of cash? What would you do? What would be different here? The other land or equipment. Yeah, whatever it is. No kidding. Could I have some land contributed, some inventory contributed, some cash contributed, some buildings and then some equipment, and have a whole bunch of different debits? Sure, big deal. Right? Everybody got it? And we always record at market value. Okay? So did that answer questions? Okay. What if what if I now buy back some of my stock? What am I going to call that? If I decided to buy some. Let's say I went out in the market and I bought some. What's that going to be, you suppose? I buy it in the market and I put it in my treasury. So treasury stock, that's why it's called treasury stock. Now, is treasury stock an investment? You bought stock. Those people that bought this stock, they made an investment in the stock and we have contributed capital, right? But if I buy my own stock, is that an investment? Well, I'd like to get rich by issuing stock to myself. I could be a millionaire tomorrow. Why not? I could issue stock to myself worth $1 million and just say I'm a millionaire. No, you don't get to do that. You don't make money by issuing stock to yourself or by buying stock back from yourself. I think I'll take 100 out of one of my bank accounts and put it in another bank account and say that I'm now worth 200. What? You don't generate wealth that way, do you? Yeah, you're just moving it around. By the way, there are a lot of frauds that do that. They make it look like they have more than they do by recording the asset, not recording the liability side, that kind of thing. Recording the revenues and not recording the expense on the other side, that kind of stuff. You put it all together and I'm rich. No, you're not. Okay, but anyway, what if I do buy this stuff back? It's not really an investment. What it is a reduction of my equity. When I buy back the treasury stock, I have less equity. Right? I bought back some of it. So just think about it here. Let's say now the market value is $110 and I buy back 100 of those shares for $110 each. Wait a minute, they gave me 100 for them, right? And now I'm buying back for 110. Give me the journal entry for buying treasury stock. So this now is treasury stock. This is issuing, right? This is just issuing stock. And we've done this before. The only thing about issuing that's different is now we have par value or stated value, right, guys? We've been doing it all along. It's nothing new. Okay, but let's buy some treasury stock. Let's try that. And then we'll actually sell it back in the market. So I go out in the marketplace, or just go to the shareholder, if it's a small company, and I buy some treasury stock. So let's say I buy 100 of these shares for $110. And I buy them with cash, of course. So what would you do? Maybe credit cash? How much?
110,000.
Yeah, it said 100 shares, right? At $110. How much is that? $1,100? Is that right? 11,000? 11,000, yeah. 100 times 110. How much is that? I had 2 zeros, right? Okay, to 110. Okay? So 11,000. Debit what for 11,000? An account called treasury stock. And again, just like you said before, come on, Keith, treasury stock. Again, what kind of an account is it? It's got a debit balance in it. It's a reduction of equity contract rate. So what we do is we list all of our contributed capital, right? The par value of the common stock and preferred stock if you have it. The additional paid-in capital, we'd add those up to get total capital, right? Then we add the retained earnings to that, okay? And then we would subtract treasury stock if we have it. That's easy. By the way, how many shares would we have? Let's see, what did I start with? 60,000 were issued? And then we issued 2 more. How many would now be issued? Authorized would still be the 100,000 we started with. I had 60 issued, and now we issued 2 more. How many would that make it? 62. How many are outstanding if I bought back 100 of them? 62 are issued, and I bought back 100. I'm holding them myself. How many are outstanding? 61.9. Everybody stay with me? That's all it is, okay? If I'm going to pay a cash dividend, though, or a stock dividend, who am I going to pay it to? Shareholders that are out there, or to ourselves? You're going to write a check to yourself? So you're not going to pay any dividends on the unissued shares. Nobody owns them, right? We do, I guess. They're not issued yet. And how about the treasury stock that we're holding? We're going to pay ourselves a dividend? Why would you write yourself a check? So we're not going to. So who gets the dividends? Only the outstanding shares. That make sense? They get all the dividends, whether the stock dividends or cash dividends. Okay? Stock split's a little different. With the stock split, we split all of them. And we'll look at a stock split here in a few minutes. Okay? So let's say we now have this treasury stock. Everybody got the idea what this is? Is it an asset? What's the answer to that question? No. What is it? Contra. Everybody got it? And contra equity should have what kind of a balance? Debit or credit? Contra debit, right? You guys got this, don't you? Right? Okay. All right. So let's say now that I issue, and this is the first time I ever bought treasury stock, let's say. Okay? First time I ever did. Let's say now I reissue these to new shareholders. And I issue 50 of them for $120 each. Let's do that. Did you figure out what that would be?
50 for $120?
120. Price went up. I get 120. I bought it for 110. Get 120. Can I have a profit off of selling my own stock? No. You don't have profits on this, right? So it's not like I made an investment and now it increased in $10 and now I do have an economic gain of 10. That's true. I'm going to have more cash by 10. I'm not going to have net income from this. No gain, no revenue. Everybody got it? No loss on selling these either. Okay? If I sold them for less. So let's do the easy part. What did I get? So here we're going to sell 50 shares at 120. Whoops, at 120. Okay. All right. So what's that? Debit. How much? This is an advanced math thing. 50 times 120. 6,000? Sounds good to me. Okay. We're also calculator dependent, aren't we? Okay, anyway. Credit what? What I give them? The treasury stock, I don't have it anymore. Oh, this is too easy to believe. Did you love this chapter so far? Now, be careful. What did I put them into treasury stock at? 110. What do you suppose I should take them out at? How about 110? Okay, so how much is that? I sold half of the 11, so what is it? 110 times 50 is 5,500, isn't it? That is not a $500 gain. I know I have $10 more cash than I gave for them, right? For each one times 500. Or I'm sorry, times 50, and that's my 500. What is that? It's more what? Yes, it's more additional paid-in capital. And guess what we cleverly call this additional paid-in capital, seeing as it came from the sale of treasury stock? Additional paid-in capital from the sale of treasury stock. Ta-da! Brilliant, huh? It's just common sense. Okay, now let's make it a little bit harder. And this is not in the book. This is just because, you know me, I'm mean. I think you ought to know what things are if you ever see them on financial statements. Terrible concept. Okay, anyway, being mean to students like that. Let's sell the other 50 shares. And let's sell them for $95 each. Let's do that. And this is the only time we ever bought treasury stock. So what's the balance in additional paid-in capital from treasury stock? It's the only time we ever bought and sold treasury stock. It's 500 in it, right? We start with zero, we have 500 in there. Everybody good? Okay, so what would this be? Debit cash, how much? This is really hard. We need a calculator for this. 50 times 95. So what is it? 4750? That sounds pretty good. That work? Is that right, everybody? Okay. What do you want to credit treasury stock for? Yeah, it's half of it, right? They were 110 each, so it's 5,500. Okay, and we don't have a loss, right? We just sold it for less than we bought it for. So what's the debit going to be? First, I think I would get rid of what? The balance in additional paid-in capital on treasury stock, don't you suppose? It can't go below zero, though. What would that be? Negative contributed capital. So what we do is we get rid of whatever balance is in that account. There's only 500 in there. That's why I said it was the first time we'd ever done it. Oh, what do I need? Another what? 250. Everybody agree? It's true, isn't it? What's that? You know, we don't have any place to put this. So guess what we do a lot of times when we don't know what to do with things? Retained earnings. I'm saying, look, I can't change my contributed capital, right? I can't have negative contributed capital here, right? I didn't buy back some of my stock or something, right? What's the deal? I reissued and I got less for it. So what I'm going to do is I'm going to say that I took some of my retained earnings and paid to this new owner to get into buying stock. That's it. Okay, so that's the idea. So you debit retained earnings. Okay. Not too bad. Simple. Get that down. Okay, good. We're just sort of rolling through the stuff, huh? So let's think about dividends a little bit. So let's say that I have common stock and preferred stock now. And let's make my preferred stock be $100 par. Let's make my common stock be $10 par. Okay? And let's say that I have outstanding shares. I'm going to do outstanding always, which is what? The issued ones less any treasury stock if there is any, right? Most companies wouldn't have any treasury stock, so what they'd say on their balance sheet is issued and outstanding is however many, right? The issued ones are the outstanding ones if there are no treasury stock. Got the idea? You see that in financial statements all the time. Issued and outstanding shares. They'll also tell you when you're authorized, okay? But we don't use that for anything in particular, okay? All right, so let's say that on common stock, the outstanding shares are 100,000, okay, got it? And in the preferred stock, the outstanding shares are 1,000. Everybody good? Okay. So what would be the balance in the common stock account if issued and outstanding, assume there's no treasury stock, if issued and outstanding is 100,000 shares at $10 par, what would be in that account? What's the total par, in other words? How do you record them? We just did it. How do you record them? At par value, right? Anything you paid in addition to that, anything your shareholders paid in addition to $10 would be an additional paid-in capital, wouldn't it? So what's in the common stock account? just $1 million, right? $10 par times 100,000 shares. Everybody got it? This working? How about in the preferred stock? What's its total par? It's 100,000, isn't it? Okay. All right. So now let's also say that the preferred stock is preferred as to a dividend, right? Oh, by the way, on preferred stock, it can be on preferred stock, it can be either voting or not. Voting or non-voting. If you were issuing the stock or buying the stock, either side, what would you expect this price to be if it's voting compared to if it's non-voting? Higher if it's voting. You have to pay for what you get, right? Okay, so there's voting and non-voting. There's something called cumulative and non-cumulative. What does that mean? With non-cumulative, if you don't get your dividend this year, if you don't get a dividend this year on the preferred stock, you never get it. It's gone. Ah. Right? But you have a preference for dividends. The preferred shareholders get their dividend before the common shareholders do, right? But if we skip a dividend, we don't have enough earnings to pay the dividend, right? So we don't declare any dividends. So we're not going to pay any dividends whatsoever to anybody. Then the preferred shareholders would not get theirs. And the next year when you pay dividends again, or the next time you do pay dividends, they don't get those old dividends. There's no such thing as dividends in arrears, we're going to call these, right? Dividends that are behind, in arrears. Okay, behind. Right? You don't get them. They're just gone forever if it's non-cumulative. What would cumulative be like? Ah, I get them. So if they haven't paid dividends for 3 years, what I get is 3 years dividends the prior years, plus a fourth year this year before common shareholders get anything. What would you rather have, cumulative or non-cumulative preferred stock? Definitely cumulative, and guess what? You pay more to get it, right? Everybody agree? Okay, so it's how you're going to share profits. So it's cumulative or not, and that affects how much dividend there is. Voting doesn't affect dividends whatsoever, okay, but that's going to affect the dividends, okay? Not yet. Yeah, okay, and then what else is there?
Is it doing weird tours?
Oh, there's actually high school kids wandering around, yeah. No, we don't really go to school here, we just sell the place. Right? Okay. I made him mad and he left. Okay, anyway, so, all right. So what else is there on this stuff? Oh, by the way, you get a preference in liquidation too on this. Okay, everybody agree with that? So if we were to liquidate the company, the preferred shareholders get their money first. And usually the preference in liquidation, by the way, is their par value or some percent of their par value, 95% of it or 105% or something like that. They get that before common shareholders get anything. So you have that too. All right. And then we've also got something called participating and non-participating. And this one's really cool. Because on participating, if you have this stock, first you get your preferred dividend. And if it's cumulative, you get all your dividends in arrears too, right? You get your preferred dividend, you get all the prior year dividends, right? So if you are cumulative, right, you get all those prior dividends, and you get the current year dividend. If you're non-cumulative, you just get the current year, right? And then after the common shareholders get some sort of a matching dividend to match what you got, right? After they get that, then you share, you participate in the earnings going forward. So what's the best kind of stock to have? Preferred stock. Voting, right? Cumulative, participating. But it costs more. And you know what? That's more like equity, right? That feels a lot like equity. You get to vote, right? Okay? Although maybe non-cumulative is more like equity, right? More like common stock, right? And then participating is more like common stock. But what if you have non-voting, right? Actually more like non-voting, cumulative, non-participating. What's that closer to? Debt. More like debt. So what we do here is we have common stock, we have preferred stock, and we have bonds. And these are the three ways you can raise money. These people typically vote. These other two don't. These people you have to pay, right? These people you do not. Neither one of them. If we don't have the money, we don't have to give the preferred shareholders or common shareholders anything. So can you see how preferred stock might be kind of a popular
financing vehicle for companies. We're real strong, we're real profitable. We refuse to let anybody else have a vote, right? We don't need to issue bonds. What for? People are willing to buy our preferred stock. And then we can pay them for profit, and we don't have to deduct. Got it? But they, obviously, you have to be pretty profitable, nobody's going to want your preferred stock, huh? Sometimes, though, you'll read in the chapter, we have convertible bonds that's convertible into common stock or convertible into preferred stock. We have preferred stock that is convertible into common stock. Okay, what is convertible mean? At the option of the holder of it, they can convert to the other thing. So let's say I have convertible preferred stock, and I have this stuff, right, and the company takes off. What might I want to do? Convert it to common. Got the idea?
How quickly do you do that?
Depends on the terms of the agreement.
Yeah.
Yeah, so you can write anything in the agreement you want. And that's the nice thing about preferred stock too, you just make it do anything.
You know, you can break it down, common stock, and you can sell very much.
Yeah, yeah. But guess what? To get convertible bonds, you have to pay more, because you now have more flexibility, right? Yeah. Convertible preferred stock would cost more. Okay, and I won't make you do the accounting for that stuff. Okay, it gets kind of complex, annoying, I guess. Okay, so let's try a dividend on this stuff. What would that look like? Let's say it's non-cumulative, non-participating for now. So we got non-cumulative, whoops, where you go to? Let's make it non-cumulative, non-participating. I'm going to get rid of it now. Let's say it's non-cumulative, non-participating. So if I had non-cumulative, non-participating stock, this is really simple, you guys. All you do is you figure out what your total dividend is going to be. Board of Directors declares the dividend. What's a journal entry, by the way, when they declare the dividend? Let's say we decide, let's put one more thing on here. Let's say the preferred stock is a 5% dividend. What does that mean? They'll do that too. They'll say, in this case, it'd be either $5 dividend or 5% dividend. What do I mean? It's 5% of the par. Okay, so when they say it's a 5% dividend or an 8% dividend or a 2% dividend, they mean of the par. Okay, so how much dividend is each one of the shares going to get every year? What do they get first before common get anything? 5% of $100 or $5, right? So it's $5. Or you could just say it's a $5 dividend, however they want to do it on the preferred stock. Okay, so $5. How many shares are there? 1,000. So what happens to the first 5,000 of dividends? Who gets it? Preferred stock shareholders. Who gets everything else that's left? Common shareholders. It's that simple, you guys. Okay, what's the journal entry when we declare a dividend? Let's say we declare a $200,000 dividend. We're going to pay a $200,000 dividend. Debit what? For dividends, what have you been debiting? Retained earnings, yes. You go to retained earnings, remember that? Or you can use a dividends account, but what kind of an account is a dividends account? It's a contra equity account that we are going to close to the temporary contra equity account. We're going to close it where? To retained earnings. So if you debit dividends, you're going to close it into retained earnings anyway, right? Which means credit the dividend account and debit retained earnings, right? You guys staying with me? Okay? Starting to understand this stuff. Huh? It's scary. I know how that happens. It's mind-boggling. Okay, so what did I say, 200,000? What would you credit? It's not cash. This is on the date of declaration. What I do is I got a whole bunch of shareholders here, right? I've got 100,000 shares of common stock. I might have lots of people owning it, right? Might be thousands of people, I don't know. Okay, and the same thing with the preferred stock. I might have a number of people owning it. Got the idea? Or certainly if it's millions of shares, you know, it's General Motors or something, young, it's lots of shareholders. Okay, so on the declaration date, what do? Dividends payable. Dividends payable. I'm not giving them shares. This isn't stock yet. Okay, we'll do that next time. Dividends payable would be 200,000. Got the idea? Well, then there's another date called the date of record. I'm going to give you points for this. No kidding. Right? I'm going to get the points in this chapter. Date of record is the date I find out who owns the stock. Because you might own the stock on the date of declaration, and you sell it to him. If he owns it on the date of record, he gets the dividend, not you. Right? If you sell it to him, though, after the date of record, you still get the dividend.
So you'll see in the Wall Street Journal on Yahoo Finance, it'll say X dividend next to the stock. What does that mean? Without it. So if you buy the stock without the dividend, that tells you, guess what? You don't get the dividend, the former owner does. That make sense? So this is so you can find out who owns the stock. Guess what kind of an entry you do, seeing as nobody exchanged anything? How about none? So all you have to do is tell me no entry. I'm not kidding. Tell me no entry.
What would be the point of buying a stock if you don't get it?
Oh, because you want the stock. By the way, if he gives me the dividend, I have to give him more money. I have to buy the dividend from him, right? So what happens as soon as the stock goes ex dividend, the stock price goes down by about the dividend, right? And right before the dividend, it's up, including the dividend. Does that make sense? So yeah, it's just deciding who gets it. Right, that's all. Okay, and there's one more. Let's do the date of payment. So, you know, this could have been December 10th. This could have been December 20th. Got the idea? And this could have been December 30th. Whatever. Okay? Whatever dates they are. You got the idea? So what would we do on the date of payment, of course? What do we pay it with? Cash. And what do you debit, guys? What do you pay off? Dividend payable. God, this is so easy. Once you know what you're doing, accounting gets really relatively simple. Okay, like any language. One other thing, who gets the dividend? That's where we started. Who gets, and we'll pick up there next time. Who gets the dividend? Who gets that $200,000? If it's non-cumulative, non-participating, there are no dividends in arrears, it doesn't matter if they paid dividends in prior years or not, right? What's the deal? How much do the preferred shareholders get out of that 200? They get the first $5,000. Yeah, 1,000 shares at $5. I love it. Okay, what do the common shareholders get? 195,000. Everything else, it's real simple, isn't it? What is that per share? I'll probably ask you something ridiculous like that. What is it per share? Well, it's $5 for the preferred, right? We took 1,000 times 5 to get the 5,000. So it's $5 per share. But what is it for the common? How would you get that? How many shares are there? 100,000 shares. How much money did they get? 195. I think it's $1.95 a share. Ta-da. Good deal, huh? See you guys. Thanks for coming on a Friday. Towards the end of the semester, middle of the semester. Kind of nice of you. Not here by myself. Most likely, because this is really easy stuff, you're going to get them all. That's dependent on me actually talking about it makes a difference. But yeah. So, probably some more points to gain. Okay?
But I meant like one of the things because you pay attention and learn.
Yeah. Is it home with Rick online? I don't know. That's cool. I have no idea. I haven't written it. How would I know?
Some days I can just feel my brain glowing.
But this wasn't hard.
No.
This stuff's okay.
When we were talking about